This new Warren Buffett-style ETF could crush the well-known monthly dividend ETF JEPQ by using the same approach that helped build Warren Buffett's investing legacy. And this is what the VistaShares Target 15 Berkshire Select Income Fund, or ticker symbol OMAH, does. Monthly income from a portfolio that's built on Berkshire Hathaway's legendary approach to investing. In this video, we're going to get into the details of how it taps into the strength of the Berkshire companies while also aiming for a 15% dividend yield, and how it stands against one of the most popular monthly dividend ETFs on the market. So let's get started. Key reasons to consider investing in OMAH ETF. OMAH, the VistaShares Target 15 Berkshire Select Income Fund, mirrors the 20 largest holdings of Berkshire Hathaway. It also provides exposure to Berkshire Hathaway directly, and it uses the experience of its portfolio managers to generate high monthly income. Now, there's 3 reasons to consider investing in OMAH. The first is that it seeks to provide high monthly income by investing in a diversified portfolio of stocks and using a data-driven options investment strategy. Second is core equity exposure, as OMAH provides large and mid-cap exposure that could serve as a portion of a stock's investments in a well-balanced portfolio. And third is the professional options management, which investors can benefit from the years of experience and in-depth research that's employed by the team managing VistaShares option-based income ETFs. Next, let's talk about the strategy and holdings. OMAH is an actively managed ETF, so there's a team that's managing the holdings of this fund, along with utilizing option strategies to generate income. And this fund seeks income and secondarily long-term capital appreciation. In other words, the main function or priority of this ETF is to provide investors with high income on a monthly basis, and secondary to that would be the potential for capital appreciation. OMAH's strategy includes 2 components. The first is that it invests in a portfolio of equity securities based on the sole active VistaShares Berkshire Select Index. The second is that it generates income through an options portfolio, and it aims to achieve an annual income target of 15% distributed monthly. And we'll get into more details of that shortly. I mentioned earlier that OMAH mirrors the largest 20 holdings of Berkshire Hathaway, and the top 10 holdings include Apple, Berkshire Hathaway itself, American Express, Coca-Cola, Chevron, Kroger, Kraft, and a few others. And OMAH's strategy includes that there's an allocation of roughly 10% of Berkshire Hathaway stock. Something also to keep in mind is that this fund does have the flexibility to invest in securities outside of the index, where it may hold between 21 to 30 holdings. Moving over to the sectors, OMAH is mostly exposed to financials, then consumer staples, technology, energy, and a couple more. Next, we have income and distributions. OMAH targets a 15% annual income for investors, which is good news for those that are looking for a fund that offers some nice monthly income, or for those that are income-focused investors. And this 15% annual target comes up to about 1.25% per month. The fund aims to achieve this target with their covered call option strategy, or more specifically, selling out-of-the-money call options on the fund's holdings and collecting that option premium as income. Depending on the market conditions, the management team will adjust call selection, strike price, how many options, and the trade timing to help reach the income target. And they're running options on all the underlying holdings on the fund, so that's 21 different strategies. Now, let's take a look at the distributions that OMAH has paid out so far this year. So of course, we only have a handful of payments at this point, given that the fund is pretty new. But starting from the beginning in March, they paid 25 cents a share, then around 23, in May just shy of 24, and then most recent in June is also 23. So overall, about 23 cents per share per month. This falls in line with that 1.25% monthly distribution amount I mentioned earlier. And when stretched out for a year, that would bring us to that 15% annual distribution target, which is a nice plus for someone looking to have exposure to a fund that could consistently offer a 15% yield. Of course, given that the fund continues to stay on track like it's done so far, but it's great to see they've been hitting the target up to this point. Next up is the taxes and fees when it comes to this fund. I briefly wanted to talk about the taxes for this fund, just so you're aware of how the income distributions may be classified as. And while some of OMAH's distributions would fall under ordinary income, there's a portion that would be classified as ROC, or return of capital. Return of capital is a return or payment received from an investment that's not considered a taxable event and is not taxed as income. Each distribution lowers your cost basis by the amount that's classified as return of capital. So essentially, your income is tax deferred until you sell your shares or your cost basis goes to zero. From the most recent Section 19A, we can see how much the estimates for ROC were on the last payout, and then the remaining is ordinary income. But just note that the final classifications won't be known until the official year-end data is provided. And of course, these percentages will fluctuate month to month. Getting into the fees, Omaha has an expense ratio of 0.95%, costing you $95 for every $10,000 invested. Now, this is a bit high, but that's what comes with the territory of a managed fund like this, which again is aiming for that high, consistent 15% yield for you. Now, I wanted to compare Omaha to one of the most popular monthly dividend ETFs, JEPQ, to show you how it stands across a few different categories. And for a quick brief, JEPQ is the JP Morgan NASDAQ Equity Premium Income ETF, and its goal is to provide monthly income and exposure to the NASDAQ 100. So it invests in stocks in the NASDAQ 100 along with selling out of the money NASDAQ 100 index call options. So one of the first things that I want to compare is diversification. So JEPQ contains around 108 holdings, and since it invests in stocks from the NASDAQ 100, it holds Nvidia, Microsoft, Apple, and others. And the sectors that it's exposed to are very similar to the NASDAQ 100, with tech being the largest. I think it's fair to say that JEPQ is going to take the win here because it tracks a larger index and has more holdings compared to Omaha, which only has 21 holdings. Next, we have dividend yield and income. JEPQ has a dividend yield of 11.3%, which is paid monthly as well. If we look over the income payments over the past year, you can see that the payments have fluctuated quite a bit. And that's because the payout will depend on option premiums. The more volatility, the higher the income, and vice versa. For Omaha, we know that the 15% is the target to not only provide, but to maintain consistently, which in this short time span, it's managed to do so. And for that reason, Omaha will take the W here. Next up is tax efficiency. Both these funds differ when it comes to their distributions. JEPQ pays an ordinary income, while Omaha's distributions can be a mix with return of capital. Since return of capital can be a tax advantage since it's basically deferring the taxes, this can be a nice bonus. For that, Omaha is going to take the win here since a portion of its distributions can be ROC. The next category is going to be the fees or expense ratio. This one is pretty straightforward since Omaha has a 0.95% expense ratio, while JEPQ has a 0.35 expense ratio. Quite a difference there as JEPQ comes in much lower, and because of that, JEPQ is going to win this category. Last up, we have performance. Now let me start by saying both of these funds are focused on providing income and not capital appreciation. If we compare the returns of the two, looking back to March of this year, since Omaha has only been around a few months now, we can see JEPQ had slightly outperformed Omaha, although it did drop a tiny bit harder during the dip in April. A longer time span would be a much better comparison, but since JEPQ has been around for a few years now and has proven some pretty solid results, for this reason, JEPQ is going to take the win here. While these funds both have their pros and cons, from a quick comparison, Omaha does fall a bit short of JEPQ. But as Omaha builds more history, time will really tell if this will change or if it'll stay this way. Next, let's get into the cons of investing in Omaha. The first reason is going to be that you technically don't get 100% exposure to Berkshire Hathaway's investments. Omaha doesn't own all the stocks that Berkshire Hathaway owns, but it does own the ones that make up the overwhelming majority. It also doesn't give you exposure to the other businesses that Berkshire owns, which in the end all do play into the returns that Berkshire has provided. Just something to note if you had assumed it was exactly the same. Second reason is limited upside potential. This comes with the territory of all cover call ETFs, which is the trade-off of accepting that long-term growth potential is going to be capped in return for the income from selling call options. Just to give you an example, here's a chart comparing the S&P 500 to a S&P 500 buy right index that replicates a hypothetical cover call strategy on the S&P 500. You can see there's a pretty huge gap between the two in total returns. The third reason is all the downside risk. So while you're limited on the upside when it comes to the cover call strategy, you still have all the same downside risk of holding the underlying assets. The next reason is for the potential NAV erosion. If Omaha is unable to generate enough income to support its distributions that it's aiming for, this can lead to NAV erosion over time, which is essentially the fund's price decreasing over time. The last reason is the limited history of Omaha. Since this fund has only been around since March of this year, it barely has any history. And while so far the fund is doing what it says it should, which is good news, it will require some more time under its belt to see if it's sustainable, along with how it performs through fluctuations in the market. This leaves us with the most important question, and that's, who is this ETF for? First and foremost, this fund is going to be for investors that are looking for consistent income on a monthly basis. Also, you should have some conviction in Berkshire Hathaway, as the strategies that the fund utilizes is stemmed from their top holdings. So if you don't like Berkshire, or you don't believe that there's an opportunity for growth for the company, then you should be looking at something else. Third is that you understand that you will not outperform Berkshire, and your potential for capital appreciation will be limited in exchange for that higher level of income. If this makes sense for you and you're comfortable and understand the downsides to this fund, this could possibly be a pretty solid income provider for you. If you want to wait and give it some more time to see how this fund does, that's 100% understandable. And if this fund doesn't sit right with you, that's fine too, because there's a bunch of other solid income paying ETFs. And if you want to learn about some other double-digit yield monthly ETFs, then be sure to check out this video here. Or if you're looking for some insane yielding high monthly and weekly dividend ETFs that come with more risk, then check out my best Yield Max ETF video here. If you enjoyed the video, be sure to like and subscribe. Thanks for watching, and I'll catch you in the next one.